Hey folks, welcome to another video by Stocktrades. My name is Matt and today we are going to be looking at two stocks that have been doing very well over the past year, and they are two industrial stocks. For those who are currently heavily weighted towards tech and or growth stocks, you're probably seeing a lot of red in your portfolios lately. The markets have been in a downtrend for both tech and growth stocks. So today, let's take a look at a more stable industry, one that is doing very well, and we'll get to those two stocks right after this. So why are industrial stocks doing quite well? Simply put, the governments worldwide are going to be investing heavily in infrastructure as we come out of this pandemic. This is typically what happens after an economic recession. We see governments start to pump money back into the economy, announce big projects, announce big spending. So infrastructure companies and industrials tend to perform quite well. And two companies that we're going to talk about today, the first one being Finning International. Finning is currently trading near all-time highs. Although it's pulled back slightly recently, it is still on the cusp of achieving all-time highs. Finning is a global dealer and distributor of Caterpillar products. As a full end-to-end Caterpillar service company, it not only sells and rents Caterpillar machinery, but also provides parts and services for equipment and engines. Finning services the mining, construction, petroleum, forestry, and power systems application industries, and it has operations worldwide. The company's primary base of operations include Canada, South America, the UK, and Ireland. Over the past year, the company's share price has been white hot. Finning's shares have climbed by approximately 67%, and as mentioned, are close to the all-time high, which was $34.77, which it achieved back in February of 2018. So the question that investors must be asking themselves is, can it sustain this momentum? Can it finally break through this $35 range and run into the 40s? Finning has been there several times before. If you take a look at this chart, you'll notice that Finning has bumped up against these levels 3 times, in 2007, 2014, and again in 2018. In each instance, the company suffered a pretty significant setback that sent the share price crashing back into the teens. This isn't exactly a chart that instills confidence. But on the bright side, as the saying goes, the past is not an indication of future success. So what will the future bring? Let's start with company valuation. Finning is currently trading at 22 times earnings, 2.3 times book value, and has a PEG, so a price to earnings to growth ratio of 1.28. In each case, while they are above the company's historical averages, they are slightly below the industry average. In fact, the company looks attractive, especially when you compare it to a company like Toromont, which we're going to talk about a little bit later. While the valuation does look attractive against industry comparables, it's important to question whether or not these valuations are justified. The company's growth profile hasn't been great. In fact, it generated less revenue in 2020 than it did back in 2014. Quite simply, there has been a lack of consistency as the company operates in a very cyclical industry. Analysts estimate that annual earnings per share will only top 2019 levels in 2022, and that revenue won't top pre-pandemic levels until at least 2024. Those are some pretty long recovery times. Couple this with the fact that Finning is trading above its 3-year and 5-year historical averages, investors should definitely proceed with caution. What about that dividend? While valuation is a concern, Finning is one of the most reliable dividend growth stocks in the country. It is a Canadian dividend all-star, aristocrat, and has a 19-year dividend growth streak. This is tied for the 15th longest streak in the country. It sports a decent yield, around 2.5%, and has also kept a respectable payout ratio in the high 50s. There's no question that Finning has been a rock-solid income stock. All things considered, Finning is a stock that is currently riding a wave of positive momentum. While this momentum could take the company into blue sky territory, investors should approach with caution. It appears that much of the good news has already been baked into the company's share price. Analysts have a 1-year price target of about $35, which I think is quite reasonable. So from here, we're looking at about upside in the low teens. Not outstanding, but not bad either. Finning looks like a decent option here, but given the cyclical nature of the industry, investors should proceed with caution. It's trading near all-time highs, above historical averages, and their momentum may cease at any point. Given the company's past and looking at that ugly chart, I'm not prepared to say with confidence that Finning is going to break through that $35 level. So just be cautious here. It's a good company, good income stock, but be cautious at these valuations. Next up, we're going to talk about Toromont. Toromont is one that I've been waiting to speak on for some time. If you'll remember, Toromont was featured in one of our weekly dividend videos in February, at which point in time Toromont was expanded to extend its dividend growth streak to 32 years. Unfortunately, that came and went, and the company didn't raise the dividend. So I've been wanting to talk about Toromont for some time, questioning whether or not the dividend was in fact safe, or whether or not there was reason to be concerned for investors. So let's start with the basics. Canadian Dividend All-Stars, there's not many of them on the TSX. There's about 100 or so. So there's very few reliable. Not like the States where there are hundreds of reliable dividend growth stocks. In Canada, our selections are quite limited. So Toromont, with a 31-year dividend growth streak, is pretty much as reliable as it gets. Fortunately, in February, the company kept the dividend steady. So is there reason for concern? Well, for starters, Toromont has a very inconsistent history of meeting estimates. But usually the results come in around expectations. So last quarter was no different. While it beat on earnings, it missed on revenue. So a mixed quarter, nothing to be concerned about. The revenue miss wasn't much. It missed by less than 2 percentage points. It was expected to achieve $999 million in revenue. It posted $992 million. So overall, not that big of a miss. On the flip side, the earnings beat was also nothing to get excited about. It too represented less than 2%. It achieved $1.08 earnings per share versus $1.06 expected. So it was a steady quarter. So why is there a concern? Historically, the company has always announced their annual dividend raise along with fourth quarter and year-end results. As mentioned, this quarter came and went without a raise. The company chose to keep the quarterly dividend steady at 31 cents per share. Over the course of the company's 31-year dividend growth streak, the company has failed to raise the dividend at this time of the year only twice, back in 2010 and 2011. In 2011, it ended up raising several times, and only once in company history had it kept the dividend steady for more than 4 consecutive quarters, and that was in 2010. So, with the company keeping the dividend steady this time around, that'll mark only the second time in history that it has kept the dividend steady for more than 4 consecutive quarters. In my opinion, the company is being overly cautious here. In 2020, earnings did take a meaningful dip. Not surprising, given the pandemic. However, Toromont has posted strong earnings growth in recent years, and despite this past year's dip, the dividend is still well covered. The dividend accounts for only 38% of earnings and 32% of cash flows. Looking forward, 2020's earnings dip is but a blip on the radar. Analysts are expecting strong earnings growth out of the company, and the dividend accounts for less than 30% of forward earnings. While the lack of dividend raised this past quarter is no doubt disappointing, investors should not be immediately concerned. It is still well positioned to raise dividends, and it is likely to do so by the end of the year. So now that we know the dividend is well covered and safe, is Toromont a buy? Despite a dip in earnings, Toromont has been a very strong performer. Over the past year, it's up by approximately 60%, and much like Finning earlier, is trading near all-time highs. Unfortunately, it's also trading near all-time high valuations and well above averages, at least when compared to its historical metrics such as price to earnings, price to book, price to sales, PEG. It's trading above average across all metrics. Looking forward, it does look better priced as it's trading at only 25 forward earnings. While this isn't cheap and still above historical averages, it's not overly expensive. Overall, I'd consider Toromont a better play than Finning. If you compare both the company's charts, Toromont has a much smoother uptrend. It has been way more reliable than a company like Finning, which has seen some pretty significant dips over the past number of years. Both aren't actually all that cheap. Both are trading near all-time high valuations, so I'd be cautious with both of them. However, if I was going to pick one today, I would pick Toromont. It just has a better history of execution, and that dividend, despite the fact it wasn't raised in February, it's safe, and as mentioned, it is likely to be raised over the next few months as the dust settles for COVID. I think the company is being very, very cautious, and I don't think that the dividend is in jeopardy whatsoever. Personally, I don't own either of these stocks. I've been looking at Toromont for a long time. I still have a hard time getting past its expensive valuations. I might decide to jump in on a dip here. It has been dipping slightly, not nearly as bad as the growth in tech stocks, but if it does dip meaningful, and I'm thinking around 10% or so, it's likely one that I'm going to consider adding to my portfolio. Let us know in the comments below. Do you own any of these companies? Finning and Toromont, both excellent income stocks, both with a different history of execution. I'd like to know your thoughts. Are either of these a buy today, in your opinion? Finning or Toromont? Let us know in the comments below. As always, please like the video, subscribe to our channel for more great Canadian content. Until next time.